Hello and welcome back to VMGA TV. Today, we're going to be talking about supply and demand, and how they determine prices in a market economy. Understanding these concepts is essential for anyone interested in economics or business, so let's dive right in. First, let's define what we mean by supply and demand. Supply refers to the amount of a product or service that producers are willing and able to sell at a given price. Demand, on the other hand, refers to the amount of a product or service that consumers are willing and able to buy at a given price. The interaction between supply and demand is what determines the price of a product or service in a market economy. Imagine a marketplace with buyers and sellers. The sellers have a certain amount of a product to sell, and the buyers want to buy that product. The price of the product is determined by the intersection of the supply and demand curves. If the supply of the product is high and the demand is low, the price will be lower. If the supply is low and the demand is high, the price will be higher. There are a number of factors that can affect the supply and demand curves, and therefore the price of a product or service. For example, changes in the cost of production can affect the supply curve, while changes in consumer preferences or income can affect the demand curve. Understanding these factors is essential for predicting changes in the market and making informed decisions about buying and selling. Sometimes, governments may try to intervene in the market by implementing price ceilings or floors. A price ceiling is a legal maximum price that can be charged for a product or service, while a price floor is a legal minimum price. These policies can have unintended consequences, such as shortages or surpluses of the product or service in question. Ultimately, the goal of a market economy is to reach a state of equilibrium, where the quantity of a product or service supplied equals the quantity demanded, and the price is stable. This equilibrium is constantly changing, as supply and demand shift in response to changes in the market. To help illustrate these concepts, let's look at a few real-world examples of supply and demand in action. For example, when a new iPhone is released, the demand is high and the supply is low, so the price is high. Over time, as more iPhones are produced and the initial demand is met, the price will typically come down. Another example is the housing market. When there are more people looking for houses than there are houses available, the demand is high and the price is high. Conversely, when there are more houses available than there are people looking to buy, the supply is high and the price is low. Finally, let's talk about the job market. The supply of labor is determined by the number of people looking for work, while the demand for labor is determined by the number of job openings. When there are more job openings than there are people looking for work, the demand for labor is high and wages are typically higher. Conversely, when there are more people looking for work than there are job openings, the supply of labor is high and wages may be lower. Technology can also have a significant impact on supply and demand. For example, the rise of e-commerce has led to an increase in demand for online shopping, while automation has increased the supply of certain products and services. These changes in technology can have significant implications for the market and the economy as a whole. So, to sum up, supply and demand are the fundamental drivers of prices in a market economy. Understanding these concepts, as well as the factors that can affect them, is essential for anyone interested in economics or business. By keeping an eye on supply and demand, we can gain insight into the workings of the market and make informed decisions about buying and selling. That's all for today's video. Thanks for tuning in to VMGA TV. Be sure to like and subscribe for more videos on economics and business. See you next time.